So we often say that there is no bad economies to invest in real estate. There's just the wrong strategy in that economy. We're going to unpack that conversation today. Welcome to Rein It In. Just a reminder, turn your phone to the side and subscribe. So before I start unpacking all the data, I want to create some additional context that is meaning for us as investors on the impact of a number of the government housing policy changes that have been put in place. Ultimately, when we break things down, it adds up to what I'm going to put in a context of three things that are going to maybe make a difference that we have to pay attention to. Firstly, the changes that they've made are going to have an impact on big rental projects that will definitely start to move forward. Secondly, there's going to be more density, which is being added to the cities in general, certainly in our major cities, Vancouver, Toronto, Montreal, Calgary, for example. And thirdly, there's a handful of changes that are going to make a difference for first-time home buyers, but only a small difference. And we really have to pay attention to that because that is where our opportunity lives. So as investors, we have to review our overarching thesis for investing in real estate. We need to consider the data as always and look at what's unfolding in really what is a global macroeconomic world that breaks down into how that impacts Canada, how it impacts our provinces, certainly how it impacts our cities. And when we look at this smattering of new housing policies, part of the opportunity that is presenting itself is how does it help or who does it help? So when we break it all down, it's going to be dependent on what province we are talking about, the landlord and the tenant rules, and what is changing or going to shift. Because ultimately we know that the goal is to have renters eventually benefit from these changes. We want to see, and the government wants to see people living in subsidized housing eventually benefit. And then ultimately, builders and contractors who are going to build more units on what are now single family lots in cities. And we see a lot of that in Vancouver, hearing a lot about it, Toronto, for example, Calgary, Montreal. This densification is a big issue. And then there's some benefits to people who can afford to save for down payments, that first-time home buyers, or who actually have parents who can gift their payments. And this is all based on just what's happened over the last few weeks. So we have to consider that about 85% of all of the money, which I think is about 40 billion, has been allocated by the feds. And it's all about rentals and building rental inventory, more housing, et cetera. And that's through programs through CMHC, for example. And that is ultimately their goal. Now, we can't, and we have to consider their ability to execute on that plan. And aside from that, we know that we just need new rental stock badly, which for us as real estate investors is helpful. But for young people who want to own their own homes, really not much has changed. So what does that mean to us? Because when we consider that even though there were improvements to down payment savings programs and minor changes to amortizations extending to 30 years and beyond, for example, there's little impact for first-time home buyers or even younger individuals who want to upgrade from small condos, for example, to bigger detached homes. Because to really help first-time home buyers, we need two things. First, we need a massive increase in new home building, which is not happening. We need lower home prices, or at least virtually no house price increases for the next few years. But in reality, we are just not building more homes. We're building fewer homes, and we're going to look at the data about that. So how do first-time home buyers even get in the game? Because as you're going to see by the data, there's actually fewer housing starts, not more. And so what does this all mean for us as investors? So when we look at the data, we see a lot of uncertainty economically. We see the headwinds facing the real estate market. And as we can see in the real estate market, there is a lot of bad news for retail buyers, for first-time home buyers, or even for next-time home buyers. So when we look at the underlying headlines or read between the headlines, this is an opportunity which is based on the fundamental reality that people still need a place to live. And like it or not, Canada, for the most part, is becoming a renter nation. Affordability is, and I think it's going to continue to be an issue for the foreseeable future. So when we continue to look at the market as investors, it's easy to see the opportunity as rental housing providers. And that is actually the wave that we need to stay in front of. So yes, it is definitely harder work to find deals, and I'm hearing a lot of that feedback from the member community as well as investors outside the community, even big developers and builders. But as I've shared many times, there is not a bad time for investing in real estate. There's just simply the need to adjust our strategy. Now we see the gap, which is the shortage of housing, the lack of affordability for first-time home buyers, and that is in fact what creates the opportunity. Right now, finding deals that make sense, that cash flow, or getting the financing for the deals you do find are all part of the headwinds that we face as investors. So, for many of us, it means we need to change the strategy. Now, in this scenario, knowing that the demand for rental housing is going to continue, if nothing else, it's going to escalate and it's going to continue to grow. And that means that placing capital in real estate as a store of value continues to make sense. That's the fundamental or an underlying thesis of investing in real estate. I would suggest that, in fact, it makes more sense now than ever. So, my suggestion for many investors is to look closer at the opportunities that exist with our trusted partners, for example, who have built successful REITs or limited partnerships or general partnerships. We look at trusted partners such as Equiton, Ferris Capital Partners, WealthShare, and that's just to name a few. So right now, if you're finding yourself sitting on the sidelines because you can't find deals, you can't get mortgages, you can't come up with a down payment, if you take that whole search for do-it-yourself cash flowing properties and mortgage qualifications off the table, you can actually look at getting into real estate with less capital investment, and you can actually, in fact, diversify your capital into more options. Now, I just want to finish by saying it's more important than ever to put our capital to work, because for anyone who is following along, whether you're looking at growing or getting past the inflation or debasement of our dollar, the bottom line is we need to put our capital to work. And we are, in fact, losing our buying power, and that is not changing or going away anytime soon. So if you find yourself, again, sitting on the sidelines because you can't find those deals, can't get that mortgage, can't come up with a 20 or 30% for a down payment, then this is the time to consider adjusting your strategy. I'll say it again, is that investing in real estate is still a great store of value. Building your portfolio is creating that financial future given the economic conditions that we face and as we look into the future. So, part of that strategy, again, is making it easier, getting your capital into the REITs, into those LPs, into those GPs, and getting your capital to work. Okay, let's dig into some of the data that supports all of that. So as always, we got to break down the data and what's happening economically right across the country. And as much as I'm going to talk a little bit about Alberta,
I know they call me Mr. Alberta, but again,
I'm not really attached to Alberta in the way many think. I'm just looking at the data and going, Alberta remains a strong economy and a great future, I guess, for real estate investors. Now, that's not to negate all the other opportunities that might live across the country, and I'll talk a little bit about that, but I'm going to be high level in some of this data, and then you can unpack specifically in the areas that you're interested in investing. So when we look at Canada overarching and the macro, if you will, we have to look at the productivity. Now, as I spoke about at the last Rein It In, we talked about when the Bank of Canada said, in case of emergency, break the glass. And that was in regards to productivity of Canada or lack of productivity. And as I've shared many times, much of what is in Canada's way in growing is the fact that our economy is primarily driven by real estate. Manufacturing trends down, import exports are pretty much zero. We're not tapping into the many resources and getting them outside of our country. We're not exporting goods the way we could. We're not spending money on research and development. Now, this is all to say that, is this going to change anytime soon?
I think not.
But we have to shine a light on the fact that our productivity remains low. Now, as you see in this chart, when we compare it to the US, and we see the trend is down in terms of productivity. And we're going to support that with one other fundamental that we're also seeing, and that is where are all the jobs going and where are they? Yeah, so where are all the jobs being created in Canada right now? And the data is actually quite sad. So we can't speak to productivity without looking at what's driving our productivity, or in this case, the lack of productivity. And that really is about how much, I guess, energy, how much money has been put into the public service sector in terms of jobs. Public sector is administrative. It is not productive. And although that creates jobs and it creates spending, it's consumer driven. That can't be considered productive. We have to look at manufacturing. We have to look at research and development. We have to look at exports in terms of getting our products out of the country, including oil, by the way. Now, having said all of that, we are not spending and supporting those SMEs, those small, medium enterprises. So we're not seeing an increase in the sectors that drive productivity, which is business and the private sector. Although the private sector is trending up, it's not even close to being in comparison into what we're driving into the public sector. That is going to keep productivity quite stagnant. So on top of productivity, we have to say, well, what does that mean? And when we look at productivity, we have to look at gross domestic product, our GDP growth. There's lots of conversations about the future. Is the recession on the horizon? Is it going to be a soft landing? Is it a hard landing? When we look at the data, it still looks like it's going to be pretty flat. Now, there's lots of things that are happening globally that could shift that. But as we sit here today, I think that ultimately we're going to stay flat. We'll go a little bit negative. I just don't see a hard landing unfolding. Although if you look at the headlines and you look at what's happening in a global macro and the wars that are unfolding, it could in fact shift quite dramatically. And at that point, we don't know. But we look into the future. If we look at Canada, productivity, we're going, okay, I think we can hold our own. So having said all of that, we need some changes to happen, and we need to look and say, okay, as investors, we look into the future, what's happening. So if we're anticipating a negative, slightly negative growth or flat growth, and then we have to look at, well, what is some of the supporting data around that? So we look at unemployment, and we see unemployment starting to tick up. Right across the country, we see small increases in unemployment. British Columbia is the low man on the totem pole, but having said that, their cost of living is the highest. Alberta still remains quite strong, but right across, we're saying that it's still well within the range of healthy. And although we were used to 5% and 5.5%, 6.5% is still a healthy number, but we need to keep an eye on it and see if it's going to be trending higher into the future. So when we look at unemployment and growing unemployment and we look at into the future, we have to say, okay, well, what do we have in terms of data that's going to support a increase in unemployment, things slowing down, what the economy is going to look like going into the future. And so when we look at this next chart, we're seeing that we have a headline called less appetite for hiring as sales decline. So that softening means that jobs are not being picked up in, especially in the private sector, of course. And then we look at the other side of that equation, which is something that we have to be very aware of. This is a flag that I've shown before, which is an uptick in insolvencies. Businesses are actually shutting down. Now, this is the wave that started back when COVID hit and there was lockdowns. Many businesses didn't survive right up front, but now a lot of businesses have been kicking the can down the road, so to speak, and we're starting to see insolvencies uptick. So we've got softening sales, but we've got insolvencies because of the financial pressures that many businesses were feeling, as well as the fact that borrowing money became really difficult in terms of how can you borrow capital at that percentage to grow your business, to buy inventory. And we're starting to see and feel the effects of that showing up. Now, will it continue? We got to keep an eye on it. Strong argument that it will, but it may just in fact flatten. This is some of the data that we're keeping an eye on. Okay, so when we look across the country, we have to also look at provinces that are strong economically. We keep coming back to Alberta. I mean, one of the things that we see in Alberta, which has been a trend for actually many years now, which Alberta continues to be that province with the highest paid weekly average incomes, the lowest cost of living, the lowest tax base overall. And I know that if you're living in Alberta, you might argue a few points around that, but ultimately you're also making more money in Alberta. So for us as investors, when we look to Alberta, we see the opportunity as investors because we're seeing tenants or we're seeing people move into that province, they're being paid well, and we're seeing relatively low rents when you compare it to what's happening across the country, especially when you compare it to what's happening in Ontario and British Columbia, the other two big provinces in Canada. We continue to look at population growth in Canada, but I'm also showing this chart here, which shows population growth in Alberta. So in other words, Canada is growing, so is Alberta. I mean, it's not that Ontario, for example, or British Columbia isn't experiencing population growth, but Alberta, relatively speaking, continues to lead the way. And especially when it comes to interprovincial migration, a lot of people from British Columbia, again, and Ontario moving into Alberta. That speaks to the affordability issue that is at hand. Now, as investors, good news for us if we're investing in Alberta. It's why we continue to shine a light on Alberta, specifically Calgary, but also Lethbridge, Medicine Hat. I guess really when you look at Alberta, any of the major cities have had strong growth, strong population growth, which of course is what's driving the rental market. Inflation, inflation, inflation. It is the headline of the day, isn't it? We look at what's happening in inflation. We look at our federal government, Bank of Canada saying
things are coming under control, slowly slowing down.
And ultimately, as I guess consumers, we look at the prices of things are not coming down. The speed of which prices are rising is slowing down. That's the CPI conversation. But then we look at Canada overall and we say, well, economically, things are slowing down. We see inflation appearing to slow down. But when we look at Alberta, you see these hotter economies, and Alberta is a perfect example of that. Hot economies drive the speed of inflation, drive the speed of which inflation goes up. Alberta is a perfect example of what it means to be in an inflationary environment. Now, having said all of that, when you look at Alberta, relatively speaking, inflation, as much as it seems quite high, and if you live in Alberta, you're saying it is high. When we look and compare across the country, Alberta is still relatively inexpensive. So we can't talk about inflation without looking at what makes up inflation and why we continue to see things increasing. Certainly we look at the cost of food, the cost of fuel, the taxflation. I mean, how can we even describe that? It's not worked into the numbers. But when we look at interest costs as part of our mortgage payment, that's part of it. We look at rental costs, which are continuing to escalate. My point is this, is when we take shelter costs out of inflation, then you start to see that we've got a pretty subtle, if you will, a much slower rate of inflation. Now, I still don't think that's going to be enough to have Bank of Canada reduce rates. That's a different conversation. But ultimately, we look at inflation and we see just how big an impact shelter costs are having on our inflationary environment, as you can see here in this particular chart. When we take shelter out of it, guess what? We're actually below target. So as much as inflation and taxflation will slow an economy down, the one thing we have to consider is the cost of debt. Now we look at government debt and we've, well over $1 trillion. Our payments on that debt are off the charts. Our taxes are continuing to go up. This is all playing into the lack of disposable income for people to put in and spend into the economy. And then, of course, we also have to look at the household debt, which is the amount of debt that each consumer is carrying, whether it be credit card debt or a car payment, for example. But certainly when it comes to housing, that debt has gotten bigger. And we can see right across the country. When you look at this chart, it makes sense that you look at British Columbia, Ontario, then we go Canada overall, but Alberta, Manitoba, etc. And that really speaks to the cost of housing in each of those provinces. And so it makes sense that there's more debt along the lines of the cost of housing in those provinces. It's all to say this, is interest rates continue to stay high. Cost of living continues to stay high. This slows down the economy because of disposable income or lack of disposable income. So that doesn't negate the fundamental fact that people still need a place to live. So as we go into the future, as we look into the future, housing continues to be a challenge from an investor point of view, but it's up to us to actually fill the gap that is being created. This goes back to shifting our strategy given what's happening economically. So household debt driven by the cost of housing, the challenges of first-time home buyers or next-time home buyers actually getting into the market, we start to see is the affordability of it all is problematic. This next chart really shines a light on the fact that When we look at affordability, condos seem to be and are, in fact, the most affordable part of housing. When we look at detached housing, they're not building more. We're actually trending down. So that affordability is not going to change anytime soon, in spite of the government's billions of dollars and their commitment to build however many homes they're going to build over the next 10 years or whatever the number is. The point is this, is that housing continues to be Canada's challenge. The data supports that economically, we're still remaining relatively strong given what's happening in the world today. Interest rates will, in fact, eventually come down, but they're not going to go down in a meaningful way anytime soon. And that for us as investors, keeping our capital at work in real estate continues to be a very robust strategy, if you will, or an effective strategy for staying ahead of these inflationary curves that we're dealing with and will continue to deal with into the foreseeable future. So as I bring this to a close, I'm going to end on this particular chart, which really just shines a light on what I've been saying. And that is that when we look at the single family construction, is basically plateaued, as they show here in this particular chart, whereas multifamily will continue to trend up, and we see that a lot of building is happening, which is the opportunity for you, if you're savvy, sophisticated, and you have the time, the energy, the knowledge to play in that multifamily space, then I think that's great. Go search for those opportunities and invest in those deals. For those of you who don't have that savvy, that level of sophistication, then going into that REIT fund LP kind of scenario with multifamily investing on the other side of it, that is in fact where the money flows. So when we bring this all together, when we look at all of the data, ultimately we look at real estate and say, yes, the argument for real estate remains really strong, investing, getting our capital to work. Then we change the strategy based on what's happening economically. We can look at the headwinds of getting mortgages, finding cash flowing deals, finding deals at all, and or we can look at the opportunity to put our capital to work, investing in another way, shifting our strategy. That's my invitation to you to consider. Don't sit on the sidelines. Get your capital to work. There's more ways to invest in real estate than just to do it yourself, stand alone. Look at those opportunities, take advantage of them. So we'll see you next episode. JG is back from vacation. We're going to be doing a segment together of Rein It In. So look forward to having JG back, give you the most up-to-date information we can so that you can make those decisions, keep moving forward. If you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.